Hello everyone and welcome to CFA Guru. In the previous video, linked below, we learned what is time value of money and how to calculate future and present value. But in this reading, we will see various applications of time value of money in analyzing the investment. Now this reading is kind of a big reading. It's not that big, but I have divided the video into 4 parts. So let's move on to first part. As we know, this reading will deal with the application of time value of money. Now these applications help us in financial decision making. For example, whether a project should be accepted or not, there are 3 areas in financial decision making. First is capital budgeting, second is capital structure, and third is working capital management. Now, capital budgeting is proper allocation of funds in long-term investments. Second, capital structure is the selection of long-term financing for investments. And third, working capital management is basically the management of short-term assets and liabilities. Now, for this, in this lesson, we will use its application in calculating net present value of an investment, its internal rate of return, which are used for evaluating cash flows. Next, we will use it to calculate portfolio return measurement and various money market yields. Now, let's move on to net present value. Let's take an example first. Assume company A wants to invest in a project which has an initial cost of $1,000, but this project doesn't start generating income immediately. It generates income of $250 every year for the next 5 years, after which project is closed. So how do we know if the project is beneficial? We can subtract the expenses from the income to know what is the profit. But wait, we can subtract it, but we won't get the true result because the $1,000 expense is in the present value, but all the $250 which we are generating as incomes are future values. So, assuming the rate of interest or opportunity cost of capital to be 5%, we can calculate the present values of each income, which gives us these present values of each income for different years at 5%. Then now we can subtract the expenses from the present value of all the incomes, which will give us the net present value. So basically, net present value is present value of cash outflows minus present value of cash inflows. In this case, $1,000 is cash outflow and all the incomes are cash inflows. But remember, a cash outflow can also occur in later period. So we have to bring that cash outflow to present value also. So moving on, what is NPV? NPV is the difference between the present value of cash inflows and the present value of cash outflows. Now the formula for NPV is this, which is sum of the cash flows upon 1 plus r raised to t, which is basically the present value of the cash flows. Now, the steps to calculate NPV are: first, we have to identify all the cash flows associated with the investment. Determine the appropriate discount rate or opportunity cost. Next, we have to find the present value of each cash flow and then simply sum all the present values. Now, when I talk about each cash flow, a cash flow can be negative as well as positive. A negative cash flow is cash outflow and a positive cash flow is cash inflow. So summing all together, we arrive at the net present value.